Imagine waking up tomorrow and discovering that the price of oil has jumped 30%. Your first thought would probably be, something terrible must have happened. But what if I told you that sometimes oil prices can move billions of dollars in value? Not because the physical supply of oil suddenly changed, but because of a single headline, a statement from a politician, a rumor about a peace deal, or even a message posted online. And here's the really strange part. The same market can completely reverse its decision just hours later. Prices rise, then fall, then rise again, then fall again. At some point, you have to ask, is the oil market actually pricing reality? Or is it just reacting to whatever story happens to be trending today? And the answer is far more complicated than you might think. Because behind every oil price you see on the news, there is a massive financial machine involving governments, oil companies, refineries, hedge funds, traders, and billions of dollars in bets about the future. And today, we're going inside that machine. Because once you understand how it works, you might never look at an oil price the same way again. Let's start with something most people get wrong. When you see that oil is trading at, say, $80 a barrel, that doesn't necessarily mean someone is walking into a warehouse today and buying a barrel of oil for $80. A huge part of the market is based on something called futures contracts. And the idea behind them is actually pretty simple. Imagine you're an oil producer. You know you'll have thousands of barrels available 6 months from now, but you have no idea what oil will be worth then. Maybe prices will rise. Maybe they'll collapse. That uncertainty can destroy your business. So you make a deal today to sell your oil at an agreed price in the future. Now you know roughly how much money you'll receive. The buyer gets something valuable too. If you're running a refinery, you know you'll need oil in 6 months. You don't want to discover that the price has suddenly doubled. So you lock in your future supply at a known price. Everyone gets a little more certainty. And that is the original purpose of futures markets. They're supposed to help businesses manage risk. But here's where things get interesting. Most people trading these contracts don't actually want the oil. They're speculators. They're betting on what the price will be next week, next month, or next year. And normally, that's useful. These traders provide liquidity. They take on risks that real businesses don't want. But when the market becomes extremely unpredictable, the entire system can start behaving differently. Imagine you've spent millions of dollars trying to predict the price of oil. Your team monitors satellite images. You track oil tankers. You study inventories. You analyze production data. You have economists, engineers, mathematicians, and analysts working around the clock. And then, a politician posts a statement. Oil moves 5%. Your entire model is suddenly irrelevant. Then, 3 hours later, another statement appears. Oil moves in the opposite direction. At that point, you have a problem. Because you can spend all the money in the world trying to understand supply and demand. But you can't build a reliable model for unpredictable political announcements. And this creates a strange incentive. The more chaotic the market becomes, the more professional traders may decide they don't want to play. And when those traders leave, the market can actually become more volatile. Think of it like shock absorbers on a car. Normally, they absorb the bumps, but remove enough of them, and suddenly, every pothole feels enormous. The same thing can happen in financial markets. Fewer traders willing to take the other side of a trade means less liquidity. And less liquidity means that unexpected news can create much bigger price movements. But there's another problem. The people who actually need oil don't have the luxury of simply walking away. A refinery can't say, oil prices look crazy today. Let's just stop buying. The factory still needs to operate. The trucks still need fuel. The planes still need to fly. The economy still needs energy. So businesses that depend on physical oil are often forced to accept whatever the market is offering. And now we have two completely different groups. One group needs the physical commodity. The other group is trying to predict its future price. Both are looking at the same market, but they are playing completely different games. And that's where the situation becomes even stranger. Because oil prices aren't only determined by how much oil exists today. They're determined by what people believe will happen tomorrow. And expectations can change faster than physical reality. Suppose a major shipping route is suddenly threatened. The immediate reaction is obvious. People think, oil supplies are about to disappear. Prices rise. But then traders start asking questions. How long will the disruption last? Will alternative shipping routes open? Will governments release emergency reserves? Will producers increase output? Will consumers reduce demand? Will the conflict actually escalate? Suddenly, the market isn't pricing today's supply. It's pricing hundreds of possible futures. And every new headline changes the probability of those futures. That's why the market can look completely irrational from the outside. But here's the twist. Markets don't actually need to be correct in the short term. They only need to constantly adjust their expectations. And sometimes, those expectations are wildly wrong. Which brings us to one of the most important forces in the entire oil market: demand. Because there's a hidden assumption behind almost every oil crisis. The assumption is that if supply falls, prices must go up. But what happens when high prices cause people to use less oil? That's exactly what economics predicts. When something becomes expensive, people look for alternatives. They drive less. They buy more efficient cars. Companies reduce energy consumption. Governments invest in alternatives. And over time, demand changes. This is happening particularly quickly in some of the world's largest economies. Electric vehicles are replacing gasoline-powered cars. Renewable energy is expanding. Energy efficiency is improving. And every barrel of oil that the world doesn't need is one less barrel that has to be produced. This creates a fascinating contradiction. A major disruption can push oil prices higher in the short term, but high oil prices can accelerate the transition away from oil in the long term. The cure for high prices can sometimes be high prices themselves. And this is where the story gets even more interesting. Because producers are also responding. When oil prices rise, producers have an incentive to pump more. They increase production. They invest in new projects. They release additional supplies. Eventually, the market can go from worrying about shortages to worrying about oversupply. And that's why the price you see today isn't just a reflection of today's reality. It's a bet on tomorrow. And this is something investors often forget. The market isn't asking, is there a crisis? It's asking, is the crisis going to be worse than everyone already expects? That's a completely different question. If everyone expects oil prices to explode, and they only rise slightly, the market may actually fall. Not because the situation improved, but because reality wasn't as bad as the market had already priced in. This is one of the most important ideas in investing. Markets don't trade on facts alone. They trade on the difference between facts and expectations. And that's why headlines can be so misleading. A headline might say, oil supply threatened. You might expect prices to rise. But if traders already expected that threat, the market might barely move. On the other hand, a tiny piece of unexpected information can cause a massive reaction, because the surprise matters more than the headline itself. So the next time you see oil prices suddenly jump, don't just ask, what happened? Ask, what did the market expect to happen? That question can completely change how you understand financial markets. Because behind every price, there is a battle between reality and expectations. And the price you see is simply where those two forces meet. The oil market is a perfect example. Governments are making announcements. Businesses are protecting themselves from risk. Traders are betting on the future. Consumers are changing their behavior. Producers are adjusting supply. And investors are constantly trying to figure out which story matters most. The result? A market that can sometimes look completely irrational, even when every participant is acting rationally based on the information they have. And that's the strange thing about markets. You don't need everyone to be stupid for the market to behave strangely. You just need millions of people trying to predict the future with incomplete information at exactly the same time. And that's why the biggest market movements often happen when reality and expectations suddenly collide. So, if you want to understand where oil prices or any other financial market are going next, don't just watch the headlines. Watch the expectations, because the market may have already priced in the news you're reading today. And if you want more videos breaking down the hidden forces behind the money and markets that affect your everyday life, subscribe to the channel. Because in the next video, we're going to look at another market that seemed completely irrational, until you understand the one thing everyone was watching.